Morning, Michelle, and thanks for joining us on Blue Notes. This is a result where the interest is really more about the future than the March half. But can you talk through how the bank was tracking before the crisis hit?
Sure, it feels like a long time ago now, I have to say. Clearly, two big things impacted our result this half. We had an increase in provision charges of $1.7 billion, and we had an impairment in our associate investments of $815 million. If I take away those and a few other small accounting changes and the like, really what happened was profit before provisions was performed reasonably well. It was up 1%. In terms of revenue, we stabilised, I think, the balance sheet in our Australia retail and commercial business. We had really strong deposit growth in our businesses, and our markets business also had a really good half. And on the cost side, I know I gave some guidance to the market at the full year. We actually did better than that because we adapted to the current environment. Absent those very large impacts, which clearly are really important as we sit here today, the business was performing reasonably well.
How are you incorporating what's an evolving credit quality landscape into how you're thinking?
Yeah, and I know you're going to talk to Kevin about our provision charges and how we got there, so I won't touch on that. But I will say when I think about credit, it's really important to think about it through the lens of capital. And really it's got three components. We've got actual losses, so how much we've actually lost on loans that are not performing. There was an increase in that from previous periods. That increase was about $228 million. So we've had some additional losses not performing, but the vast majority of the provision charge we took was putting money aside for potential future losses, and that was a bit over $1 billion, so $1.048 billion. And what that is that's quite forward-looking, and Kevin will go into the detail of how it works, but that's really just putting money aside for the future. And then on top of that, the other thing that impacts capital is over time, as conditions worsen, we hold more capital for customers. So we call that downgrade. So we downgrade the risk weight we apply to customers and we hold more capital against them. We haven't seen much of that in this half, but that probably will start to emerge if economic conditions continue to worsen.
Can you run through ANZ's capital position and any implications for the dividend?
Yeah, so we're in a really strong capital position. We have been for a long time. We've been above unquestionably strong for quite a while now. We finished the first half at 10.8% of core equity tier 1 capital. That's still above unquestionably strong, a bit over $1 billion above. What's driven that capital over the course of the last half is we had an increase in earnings. We also had the credit charges I spoke about, and we had some growth in our business as we supported customers, predominantly in the institutional business. So all of those things together is what took us to the capital number. As we go forward, it's really those three components we'll be looking at. You asked the question about the dividend, and we've been prudent in our decision on the dividend, and the reason is not our capital position today. We are in a strong capital position. The issue right now is we've formed a view on the economic environment, but no one knows what the shape of the economic environment is really going to be, and we think until there's better clarity, the right thing to do is be prudent, and that's why we've taken the decision we have.
In the financial crisis, bank funding and liquidity were real issues, but is that the case with this crisis?
So in any crisis like this, liquidity is absolutely the first thing you look at. So it's a very good question, Andrew. Going into this crisis, we were in a really, like I said on capital, in terms of liquidity, we were also in a really strong position. We were well above what the regulator required of us and also well above our own management targets for what we thought was acceptable. Actually, in a way, we were overfunded going in, and that was giving us a bit of a cost in terms of margins. As things have transpired, the actions of central banks around the world, including the RBA here and the RBNZ in New Zealand and others, have meant there's more liquidity available in the system. And then if I combine that with the behaviour of our customers, who have actually many of them are choosing to save more right now, and so our deposits have increased significantly as well. So from a liquidity perspective, we feel very strong, and actually we don't need to access term wholesale markets for quite a while if we don't want to.
The support measures ANZ has offered across retail, commercial and institution, they're in the long-term interests of shareholders and the economy, but they come at a cost. So how are you managing that?
Well, I mean, the way we think about them is doing the right thing by our customers by those measures is actually doing the right thing by us as well, because the reason we've put them in place is to actually give customers some time to work through the immediate impacts of this crisis, and over time that should bode well for our customers, and in doing that, that's ultimately better for our sustainability as well.
How should shareholders be thinking about those core metrics, the typical metrics, capital, return on equity, cost to income in this kind of environment?
I think capital's what's really important right now, and certainly that's where our focus is. Some of those other metrics will fluctuate in the near term. So, for example, if we put we add more to our provisions in one period because we want to put more money aside for the future, that will have a short-term impact on profitability. Ultimately, what's going to matter and what influences capital at the end of the day is what your actual losses are and the shape, the credit quality of your customers at the end of the crisis, and that's what's going to determine your capital levels. So we might have short-term fluctuations, but it's really with an eye to the future and where our capital's going that's really going to drive a lot of our decisions. And as I said, we're taking a really prudent approach to that. Just trying to make sure we've got the right balance between making sure we support customers, but also we maintain a strong balance sheet for our shareholders.
Thanks very much for your time, Michelle.
Thanks, Andrew.